It's February, or if you're catching this later, it is probably March or April, which means that you just got hit with some pretty exciting compensation. Maybe it's a bonus, maybe it's a salary increase, and to top it off, some RSUs just dropped into your account, which on paper sounds amazing, right? You've just had all of these new pieces of compensation. You're looking at that year-end number thinking, wow, 2026 is going to be a really good year for me financially. Until you pause and realize that, wow, this is a lot of different moving parts that I'm now getting hit with. Now, if you got all of these things at the beginning of the year, the good news is that you can plan for them and have a strategy. If it's towards the end of the year, you're going to have to act quickly and really get a plan in place, because not all of these pieces of compensation are treated the same. And the mistake that I see so many different people make is that they think their RSUs are taxed the same as their bonus, as the same as their income or their options. Not everything is treated the same in terms of what it means for your wealth building in the future, what it means for your taxes, and how it needs to be treated in your financial plan. I'm going to spend some time today breaking these down for you so you have the clarity and that you know how to properly communicate what you've received in terms of your compensation package to your financial team to make sure that you can utilize this and not just send a huge check to Uncle Sam for taxes because you didn't have a strategy and a plan behind everything that you have just had fall into your lap. Now, before we dive into this conversation, I want to give you a little disclaimer that everyone's situation is going to be different. Things are going to vary based on what type of compensation you received, if you are at a private company versus a public, what your tax filing status is. So I want you to make sure that you are working with a financial professional who understands your financial situation in and out. And this is all just for educational purposes so that you can then go and feel confident when you are looking at your own financial picture and communicating with your financial team. Now, this is an exciting time, right? You've had all of these different amazing things happen between the RSUs and your salary increase and a bonus. It is what every person dreams for and gets excited about. You have different pieces of your financial picture coming into play. But there are a couple things that you need to be aware of. You're going to see your taxes spike now because all of these new forms of income have fallen into your lap. You're also going to see a really big fluctuation in your cash flow. A lot of times I'll see clients who get 1 to 2 big bonuses a year, and part of our strategy is then saying, okay, how do you then look at this when you are saying, what does my actual salary and compensation look like throughout the year? Because you'll have 1 or 2 months where you have an incredible amount of money come into your bank account, and others where it's just your traditional income coming in. The third thing is that if you are receiving stock compensation, whether it's private or publicly held, you now probably have a concentrated position of your stock that you received. And this can add up very quickly, especially if you're not paying attention to it, and especially if it is a large portion of your compensation package. A lot of times I'll see clients that are receiving stock, like I said, whether it's public or privately held, and it really starts to add up. And you need to be mindful of, am I now having a concentrated or a large position in this one holding? And it can creep up on you, and I see it happen all of the time. Now, I want us to go over a couple mistakes that I see happen. Is the first of which is that a lot of people will get so excited because they've had this great thing happen. It feels like Christmas morning, your bank account is full, your investment account looks great because you've had new shares added, and you're thinking, this is awesome. You have a checklist maybe running in your head of things that you want to purchase or ways that you want to spend the money. And what happens is people don't pause. They get so excited because they had this jump in income and they say, ooh, I'm going to go and spend it. I'm going to go do this and I'm going to go do that. There's nothing wrong with you. It's just human nature. So I always love when clients communicate with me ahead of time and they know, oh, I'm going to be receiving this type of money, whether it's in the form of stock or a bonus or a salary increase. So we can plan for it and say, okay, here's what we're going to do. And here's every different place that the money is going to go. The other thing that I also see happening is they forget that they are receiving this stock and it'll quickly pile up. And then that's how you end up with a concentrated stock position. And if something happens in the markets, they will see big swings and they will see the change in their wealth happen very quickly. And it's not what they expected. And it can be for the better and they continue to then rack up value in this stock. Or if something happens and there's a downturn in the markets or with that company, they can lose a large portion of their wealth because it was all concentrated in this one position. The other thing I see is that people don't look at their full financial picture when they're making tax decisions. They say, oh, I just got this bonus, or oh, I just got some stock positions, and they just plan for that one tax, or from a tax perspective, they're just planning for that one event. They're not looking at their full financial picture, or they're also not looking forward to other years of their financial picture. When you are working on a tax strategy, it should be for both this year and also into the future. So many of us want to pay the lowest tax bill in this moment. The goal is to pay the lowest tax bill during your lifetime and also for the lifetimes of future generations. The last mistake I often see people make is that they start reinvesting their dividends, or they start investing a lot of their money that they've now just had come in without a plan. They get excited, right? You've had this money come in and they're not spending it or saving it. They are then thinking, okay, let me go and invest it. But they don't have a plan or strategy behind what they're doing, and they quickly run out and they buy things, what their neighbor tells them to do, or what seems like a good idea. They're not thinking about their long-term strategy and what they're going to need this money for down the road. Let's start by diving into RSUs, restricted stock units. A lot of people are so quick to forget about these when it comes to their compensation, and they actually add to your ordinary income, so it is essential to make sure you are accounting for them. Now, let's say you have your salary and your bonus. That is not where your ordinary income ends. If you are receiving 1,000 shares of ABC stock at a $50 price, that's now $50,000 worth of ordinary income that is being added in addition to your salary. So if you have a $300,000 salary and now this $50,000 worth of RSUs, you are up to $350,000 of ordinary income. Yes, you're going to have deductions and things that come from there, but it is essential to know this because it could impact your filing, what you are able to contribute, different deductions you're eligible for, so you need to make sure you understand this. In addition, RSUs are now being given to you. You have stock. And once again, it's very easy to then quickly add up and have a concentrated stock position. Now let's dive into bonuses. Bonuses are one thing that, because they're not always guaranteed, it's also easy to forget about them or brush under the rug the tax implication that they can have. Now, bonuses are essential to pay attention to and communicate to your financial team, because this could be a great way to, number one, get more money into your 401k if you're eligible to contribute based on your bonus income into your 401k. And number two, it's essential to take a look at them to make sure you are withholding enough taxes. A lot of times there is a big misconception about how much you should be withholding on a bonus, how everything is going to be accounted for. And this is an essential time when your accountant and your financial advisor should be working together to help you navigate this situation on how much you should be withholding, how to navigate, and what to be doing with that money when it comes in, especially if your bonus is a big portion of your compensation, which for so many people it is. The last one I want to touch on is ISOs versus NSOs, which are a type of stock option. Now, this can get a little more complicated, especially if you work for a private company, because the valuation of what you are purchasing or what you actually own gets a little more tricky, because you can't just log into CNBC or Bloomberg or Yahoo Finance and see the value of what you own. Now, ISOs and NSOs will be a separate episode on their own because they have a lot of different nuances that I want to take time and dive into. So keep an eye out for that later this year. But make sure you are working with your financial team to make sure they are helping you navigate this situation, because they often come with a lot of deadlines that you need to be aware of. One of the last things that you should be doing once all of this compensation reaches their respective accounts is really making sure that you then have a plan and a strategy for where they are each going. Yes, you need to let them settle before you can start moving things around. You can have these conversations early on with your financial team if you know what's going to be coming in. I always love when clients send me those emails saying, hey, Caroline, I'm going to be getting a bonus. It should be around X, Y, and Z amount. It's going to hit my account at this time frame. And we get a meeting on the calendar scheduled before then, so we can talk through and reassess our financial goals, see where that money should be going. So when the money hits the account, we know exactly where each dollar should be housed. And this could be everything from, and it really should be a good mix depending on where you are focusing and aligning your goals. It should be a good mix between what are you putting into retirement, what are you putting for short-term goals, long-term goals, and how are you also making sure that you are mitigating that concentration risk. You need to be looking at all these different factors. I really encourage people to not just go gung-ho on one thing. When I find that people go all in on one big thing, they then feel like they got robbed of their big payday. And when they say, you know what, I'm going to use all this money to go out and buy a car, the excitement of that moment typically fades. So when you are using this and you're saying, hey, I'm going to put a portion of this towards a car, and we're going to be putting a portion of this to invest for the future, you then feel like you are truly building wealth rather than going all in on one area of your life. You may have a lot of those things checked off, so that might not apply to you. Everyone has a slightly different situation, but this is a great time to, like I said, be working with your financial advisor and figure out where should every dollar be housed for the future. Another key thing is to make sure that you are working with your accountant, because you may need to set aside money for your taxes. A lot of times your employer will not be setting enough aside, not necessarily their fault, but because that's what has been elected. And when you have a big deposit like this with additional funds, your tax bracket is going to increase, and you'll see different taxes pop up that you may not have originally accounted for. And so make sure you are working with your tax strategist and your financial team to set more money aside for taxes if need be. So many times I see people get a surprise tax bill the following year because they are going, oh my goodness, we didn't set enough aside, I didn't have enough withheld, and then they are scrambling trying to pull from different accounts or investments. And I don't want to see you get into that trap and have to mess up your financial situation or things that you've done because of poor tax planning. This is something you can start having a conversation with now, and it's never too early to start looking at this for the future. A big thing is to also make sure that you are planning for this concentration risk. Now, I know I've talked about it a lot in this episode, but I see it happen time and time again, especially for those that are later in their career, especially if you are with a company for 10, 20, 30 years. You can amass a lot of stock, and then it becomes such a large part of your portfolio, and then you can see these big swings, as I mentioned early. Now, you need to plan for this in terms of what does it look like in taxation purposes if you are to sell. I'm not saying you should, it's not always the right strategy for people, but what does it look like from a taxation standpoint? What does it look like financially for your future? And number 3, what would you then take those funds and reinvest them into is a great conversation to have with your financial advisor, because you don't want to just have this money now sitting in cash unless you're planning to use it for something. You want to have a strategy behind everything that you're doing to avoid the concentration risk, but also to plan for your future. And that is the key theme of this episode. Yes, I can keep going into nuances and taxation forever, but like I said, everyone's situation is different and nuanced. That's why it's so important to get your individual advice. But the biggest thing is to be communicating with your financial team and to plan and prepare early. As soon as you know about these things, make sure you're telling your team, make sure you are setting aside a strategy for it, because the more time you have, the more moves that you can make that are going to help you in the long run, both save in taxes, prepare for the future, and build incredible wealth and legacy. Thank you so much for joining me on this episode of The Wealth Cafe, and I'll see you soon.